about self-storage investing, and we do self-storage syndications. My name is Ryan Gibson, Chief Investment Officer, co-founder of Spartan Investment Group. We're a Colorado-based company. We're out of Golden, Colorado, just down the road from Coors. And we put together solicitations under 506B, Regulation D, where we take sophisticated and accredited investors, so we do non-accredited as well. The term for that is sophisticated. And a little bit about our company. We've raised about $14 million of syndication funds to date. That number is actually going to jump to about $20 million at the end of November, since we just completed a round for a self-storage property in Fort Worth, Texas. We have $85 million of projects underway in our pipeline, and we've had 9 completed syndications that have gone from, as Carlton mentioned, purchase, operate, cash flow, sell, payout investors. So we have about 7 additional projects that are in our portfolio now that are operating and eventually will sell. A little bit about me. Kind of a fun story. Airline pilot for Alaska Airlines for a while, and then moved on to Delta. That's kind of my background, flight operations management as a chief pilot. Worked for the FAA as a consultant in Washington, D.C. for a while. My business partner, Scott, he's an Army vet, served in Iraqi Freedom, and is also he's a project management professional, taught at the Catholic University in project management, and he moved in here, and I bought this house here. So I bought this house in 2009. He was walking down the street with his wife. They looked at this house. We moved in, became neighbors, and then we eventually became business partners. Our first flip together, because we used to do flips, was this house. So 1352 L Street Southeast in Washington, D.C., right in our nation's capital. That was our first flip. We bought the house for $100,000. We put $150 in. We sold it for $550 in 6 months. So we really got into the habit of finding properties off market, being super conservative, being strategic, and doing that. Scott has since sold his house. He renovated it. We renovated this one, and my rental property, sadly, it's a rental property now, closes on Friday. So I'm kind of excited about that. And our mission in our company was to improve lives through real estate. We tried to find distressed properties and work with the sellers, work with our employees, and try to find solutions that are good for everybody and serve our investors as well. So a little bit about what we've done. We've done syndications for a variety of different asset classes. Our primary focus now is self-storage, but we've purchased over 100-unit RV parks for workforce housing in the Permian oil basin in Texas. We bought up neighborhoods in Washington, D.C., where we take multiple lots and we split them into more lots and we sell them off to home builders. We've taken condos where we take a single family home in Washington, D.C., convert it into multiple condos. We've done a syndication that way. And we've done even ground up development of self-storage where we buy the raw land, take it through all the entitlements, and eventually sell it. Oh, oops. I think I freaked it out a little bit. Okay, so this is our team. We've got about 11 employees at our corporate headquarters in Golden, Colorado. We have 21 employees nationwide. The other 10 or so employees work at our subject facility sites. We are the direct property management group, and we're the asset manager, and we're the GP. And we put together the funds. So we actually are a little bit vertically integrated in that regard. We do the whole soup to nuts process. We don't hire an outside property management company. We like to have the control in-house so that we can control the quality and have a grasp on all aspects of the operation. A little bit about our team. We like to ski. We're out in Colorado. This is us at the ISS conference just this past fall, I believe. And that's us in Crested Butte. We did a little company retreat where we skied out of a condo and worked for a week and just did some team bonding and some team exercise things.
ISS stands for?
Inside Self-Storage. So if you're interested in self-storage investing and learning about it, there's 2 associations you want to look at. That's the ISS, Inside Self-Storage, and the SSA, the Self-Storage Association. Those are the 2 kind of main body governing the industry. So who's a Marie Kondo fan? You guys know the Marie Kondo show? If it doesn't spark joy, put it in self-storage on autopay. Right? That's what we do in America, right? If it doesn't spark joy, we put it in a self-storage, we put it on our credit card, and we let it accumulate in a self-storage facility, and we may or may not go there, or maybe we go there a lot, or things like that. So, a little fun joke. So there's a little bit about the industry. $38 billion industry. There's about 2.3 billion net rentable square footage. There's about 44 to 52,000 self-storage facilities. That number is always growing and changing. And there's about 7.06 square foot per person utilization. So if there's 100 people in this room, there's about 700 square feet of self-storage utilized. Who has a self-storage unit in this room? Okay, 1, 2-ish. Okay, so it's about the national average. So that's how you know, we'll talk about that, how we calculate demand to figure out if a market's saturated or not. About 9.4% of households use self-storage, and the average price per unit is about $91 a month, about just under $100. So during the last recession, this asset class was recession-proof. Rents grew in the last recession for self-storage. So if you look back over 20 years, you look at the asset classes that perform the best during downturns. There's 2 asset classes that perform the best: self-storage and office, or medical office. So one of the big reasons is because of life events. People move, they get divorced, their family's growing and shrinking, they downsize, they upsize, whatever it might be. People in a growing economy are buying more and more belongings, or businesses are booming and they use self-storage. In a shrinking economy, people are going from a big house to an apartment, and they have stuff, and they have a personal attachment to their belongings. So self-storage is very dependent on life events. So it was one of the least foreclosed upon asset classes in the last downturn. A little bit of analysis that we did. Our team sat down in 2016. We were flipping condos. We were buying and building property in Washington, D.C., very challenging market. And the deal flow is just really hard to come by in single-family residential. Countertops, cabinets, appliances, contractors, finding the next deal, grinding through the next project, intense competition. Everybody wants to flip real estate, TV shows, things like that. We kind of saw the writing on the wall. Those $100,000 houses that we could put $150 into and sell for $550, that stuff was going away. And we also kind of saw the recession potentially coming. So we looked at every single asset class and we said, where do we want to put our focus over the next 5 years as a company? And we looked at mobile home parks, RV parks, self-storage, multifamily, and we settled on self-storage for a number of reasons. This is one of the things that we looked at. You can see this is ending at 2016. And this is what we looked at the time. We said the REITs in self-storage are outperforming the S&P and the market substantially, considerably. So who uses self-storage? Is it just people with too much stuff? Absolutely not, right? Our team has a kind of a fun, we like to have goldfish at all of our company meetings, right? So this is at one of our properties, and I saw this goldfish stash leaving the property. And I thought, oh my God, there's a stash of goldfish, a huge truck full. So this is just one of the things that self-storage is used for. Businesses store their food, their newspaper delivery, chamber of commerce, sheet metal guys, sports teams, recreational equipment, you name it, everybody's using the storage for a variety of different reasons. It's not just people with too much stuff.
It's warehousing.
It's mini warehousing. That's exactly right. Why did we get to it? Some of the 3 things that we liked the best about self-storage investing was easy to evict, easy to operate, easy to maintain. Okay? So you got a unit and people move out. If you have multifamily, you're doing countertops, cabinets, appliances, trim, paint, doors, locks. You're doing all kinds of things to a unit when you turn over a tenant, right? In self-storage, we don't have any of that. I have a 735 unit facility in Dallas, Texas that has 1 toilet, right? 1 toilet. And actually the 1100 unit that we just bought has, I think, 2 toilets, which is nice. So why self-storage? Tonight's all about, there's a theme of tax strategy and what to do. We're all in this because it's tax advantaged, right? Whether you're doing a single family, multifamily, self-storage, it's all tax advantaged. But really, when you look at this chart, automation is where we start to peel away from the rest of the pack. Our ability to book a unit is simple. In a single family or multifamily, you've got to have a leasing agent, they come over, they've got to show the tenant the property, they have a whole leasing office, things like that. We have that too. But they can book a unit online, they get a code, they get access to the gate, they get a unit assigned to them, they don't even have to talk to anybody. They can call a call center that we set up, they don't have to talk to any of our on-site staff. We have a facility that we run remotely that no one's even there. And they can access the facility by pulling up to the gate, either calling the number or booking online. Rent recapture, we're going to talk about that a little bit. Rent recapture is essentially our ability to get back rent that we lose. What happens if your tenant stops paying in California? I don't know what the rules are here, but what happens when the tenant stops paying?
After 60 days, it goes to auction.
Goes to auction? And how long does it take to evict?
90 days.
90 days. And do you get any money back from rent lost, or they move out and that's it?
It depends if you get money back during the auction.
Mm-hmm.
Right now, I manage a self-storage. Right now, all auctions are online.
Oh yeah, no, not self-storage, residential. Residential, sorry. I was like, oh, that sounds really
It could take a year.
Could take a year, right?
And you're not going to see your money.
You're never going to see your money. They're going to tear the place apart. You're pretty much sunk, right? And self-storage, like you were mentioning, most states that we operate in, it's 60 days. And what happens is we do all of our processes online. We file in the newspaper. We do the whole self-storage online auction. We can auction off the customer's belongings, and that money can be used to recover the losses that we lost in rent. And we get our unit back. And I don't care if they trash the unit, because all it is some partition walls and concrete floor, right? We sweep it out, they're gone. Storage wars. Now, storage wars is, it's a little bit fabricated. It's a little dramatized, I should say. A lot, thank you. Yeah, as a manager, you can appreciate that. So, actually, those guys started a company called selfstorageauctions.net. So if you went to their website right now and typed in the zip code for Costa Mesa or whatever, you could actually get alerted whenever there's a self-storage auction happening in your zip code. And you could bid on stuff online. That's how the real world, that's how it happens today. And we make sure all of our customers know that they can go on that to see auctions that are happening at our facility. And we do auction off units if you don't pay. So that's really it. And the low maintenance, we talked about that. So this is a picture of my wife and I. We're in the mountains. I can't think, we're in the Canadian Rockies. And we were hiking, and she's our asset manager, so she does all of our property management, asset management. It's a family business. And she texted, or she said, "Hey Ron, we just booked 3 units." I was like, "What do you mean?" She's like, "Oh yeah, we just booked 3 units." It just came through her phone while we were hiking in the mountains. Pretty cool. No interaction with the customer, nothing. They just pulled up to the gate, they booked the unit, and off they go. So this is my house in Cleveland, Ohio. It's for sale if anybody would like to buy it, off market, as a tenant. About 100 grand, rents for about 1,300. Pretty good deal. Let's talk about this. So my eviction timeline, like saying here today, about a year. I think in Cleveland it's 6 months, something like that. It took me 6 months to release this in the wintertime. In Cleveland it gets really cold in the wintertime. It's not very enjoyable to have a property sitting there empty thousands of miles away from your home, knowing that there's nobody in it. That's really bad. When I did get a tenant, now I have to get a C of O every year for this property. Inspector has to come, they sign it off. They came up with $2,500 of repairs. That's more repairs on this property than we spent on an entire 130 unit self-storage that we own in Aspen Park, Colorado. And one house, after 6 months of vacancy. In storage, like we talked about, 30 to 60 days, we get profit from the auction, and we get our rentable unit back. That's the important thing. And this is the storage wars, guys, just to kind of How about we're raising the rent? Now that I have that property released, do I want to raise the rent? I'm scared to death to raise the rent. They move out again, that could be 6 months and another $2,500, right? And for what? The $300 a month that I might be clearing after I pay my mortgage and expenses, right? When? What if they move? That's going to be very stressful on me. I'm not going to raise the rent on this property, right? You going to come move that for $10 a month in storage? If you have a storage unit full piled high and you get the rent increase, are you going to drive in there on a Saturday and figure out what to put all your stuff or move facilities or things like that? Probably not. We just did rent increases on a property takeover that we're going to talk about tonight, and we raised the rent on 200 units and 7 people moved out. The 7 people that moved out, we were replaced with higher rents than where the rents would have ended up based on the market rates that they're coming in at are being, because they're higher. The other thing is set 10 sources of revenue. Can I come up with 10 ways to make money on this property? No, it's single point of failure. If the tenant moves out, that's it, I'm done. I'm no gross revenue. In storage, we've done things like propane distribution. This is one of our facilities that we sell, we do propane exchange. So somebody could come in and transact and we do a propane exchange, fill their tank, swap a tank, whatever. We do tenant insurance. So on these facilities, we partner strategically with an insurance provider, and if they use our insurance provider, we split the proceeds, usually 40 or 50% of the insurance. So if I sell you an $8 policy per month, we collect about $4 of that. You're probably familiar with that. Merchandise sales, boxes, taping supplies, packaging, anything in the retail center, we can sell that and make a profit off of that. Extra land, we can rent out boat, RV, and other uses of storage. If the land is, if it has an easement on it, we can't put a permanent structure, we rent it out for boat and RV storage. Storage auctions, I think we hit on that quite a bit. Ice and vending. We have ice and vending machines at our properties. P.O. boxes. You put 200 P.O. boxes on a wall and you charge $200 a year. In some markets, you can make quite a lot of money on a P.O. box store. We also do notary services, and we do FedEx and UPS drop. So we get a percentage of the packages that get weighed, and we do a notary service. What we're doing is we're creating a retail experience of convenience. You can come there, you can pack up your boxes, you can ship them, you can get something notarized, you can put your stuff in a storage locker, you can check your mail, things like that. Truck rental. Okay, we have U-Haul that comes in, they rent the ground basically from us, they manage the trucks, and we collect a monthly check. Cell phone towers, right? If there's a property that we have that's strategically located or there's interest in that, you can triple net cell phone tower to a company for as much as $2,000 a month, which is significant for valuation. So these are kind of the two types of properties that we at Spartan Investment Group look for, because we're trying to add value and really grow the value of a self-storage business. So we want two things. We either want a property that exists that we can expand additional units on, or like this one in Seattle where we're building from the ground up. So those are kind of the two ways that we add value to our projects. And if there's anything that you take away from self-storage investing tonight, the one thing is that you have to make sure the property has enough demand to execute your business plan. Somebody might come in and say, oh, I've got this self-storage facility, it's great, and it's got all this land, you can expand upon it, but there's 4 other facilities being built around you that are going to absorb all of your demand, and you're never going to be able to lease up your units. And now you spend millions of dollars building your additional units, and you have no customers. You have a big problem. So Lindsay Lewis is our Director of Business Intelligence, and she does all of our demand studies on all of our properties. And she looks at these things: demand, population, rental growth, saturation, jobs, permits in the pipeline, and rental rates, right? If the rental rates are depressed, you probably have some demand issues, right? This is where we look. So our company took the 3,600 cities in the United States, or they call them metropolitan statistical areas, and we narrowed it down to 150 markets that have the perfect ingredients for self-storage demand. So these are the markets that we focus on. If a deal comes in, we throw it in the trash if it's not in one of our markets. So these are kind of the places that we focus on. SpartanMap.com is we publish these online.
So none in Southern California. Is that also because of the cost of land?
We don't look in California. I love California. We come out here on vacation all the time. But we just, our developments, we just like minimizing development brain damage. That's. It's really hard to build in Washington. It's really hard to build in California. And it could take years. There's lots of rules here. We're okay with rules, but you know, it's tough. It's tough to do business here. So,
What was the name of the website you just had, Spartan?
SpartanMap.com. So, you know, markets like, you know, Detroit, not a lot of population growth there. I'm from Detroit, so I can say whatever I want about it. And you know, we look for trends, right? I mean, you can see the Pacific Northwest is getting a lot of growth, tons of growth, job growth, population, right? People are moving there. That's the market you want to be in, because population is the #1 driver of self-storage demand. The more people there are, the more demand for self-storage, right? So this is my wife Jackie. She does our operations. So she does all of our asset and property management. These are the typical things that you see in revenue and expenses for a self-storage facility. So she manages all these things. So when we look at a property, we do our pro forma, as Carlton perfectly articulated, where we go through all of the projections for the facility, and we look at historicals on our current existing operating properties, and we pro forma out so we can derive the returns for our investors. So Jackie's behind that. This is Ben Lapidus. He leads our acquisitions team. We have 3 people on our acquisitions team, and we look at about 1,000 deals a year. In 2018, we looked at 880 deals. Of those 880 deals, we bought 3. So we're not finding the first deal and jumping all over it. When we find a deal, or a deal comes to on our desk or across our plate, the first thing we try to do is kill it. Say no. How can we get this thing off our desk and move on to the next deal? Because there's a lot of junk on the market. So that's the value that a syndicator can really bring to you, is that they're going through hundreds and hundreds and hundreds of deals before they've packaged it up and put it on your desk. So you're looking at a lot of effort, a lot of broken, we have a line item in our books called broken deals, right? And we put tens of thousands of dollars in our broken deals line item every year, because we take trips to properties that fail, right? So that's a little bit about our acquisitions. Tonight I'm going to talk about a deal that we actually bought. This one's already been funded, and we've owned it for just under a year. It's just south of Dallas, Texas. It's in Corsicana, and I'm going to talk about the opportunity. So this is a $6 million facility, and it had $443 of NOI on it in place when we bought it, and that was about a 7.38% cap rate, which is really good for storage. Storage usually trades between 5 and 6% cap rate. Some markets it's sub 4, right? So in some urban areas it's trading sub 4%, just depending on the demand and the opportunity.
Right.
Yeah.
Since we have some new investors in here,
Sure.
Can you
Yeah.
explain what cap rate means?
Yeah. So imagine you were to buy this property with cash. This is the easiest way I can describe it. If you had $6 million in your bank account and you just plop down cash, your return is 7.38%. Fair? Now, if you lever it, right, you can make the return go higher. If you put a loan on it, do some other things. But it's an apples to apples comparison of the producing revenue that the property has, okay, after expenses are paid. Now, if you lever, if you put a $2 million loan on it, and I put a $4 million loan on it, that's unique to us, right? You could do that, I do something different. But if you just were to buy it straight cash, that's your cap rate. So a lower cap rate is a higher value property, right? A higher cap rate is a lower value property. Okay, makes sense? If you pay a lot, your return is going to go down, right? That's why your cap rate will get smaller. Okay, so in the market they'll say, oh, cap rates are compressed because lending is becoming looser, right? That means that people can pay more for a property because accessible cash is more available, right? That's the environment we're in right now. The government is pumping millions and billions and trillions of dollars into the economy, and lending is loosening, and more funds are available. You can get multifamily property loans right now sub 3% for CMBS. You can get HUD loans for very, very cheap, very, very attractive. That's driving up prices in the market. Same thing with storage. Investors want to be in this asset class. So it's becoming more and more institutionalized. That's driving up prices. That's making it difficult to get yield. Yep.
Is that a good number for 2019 compared to, say, 2008?
That number?
Yeah, how do you know that's a good number?
So it's a good number because you can see what other properties are trading at in the market. So we,
Same area.
in the same area, yep, same area, or just in the asset class in general. So 7.38% is a very good cap rate.
Has that been declining or
Yes,
increasing?
declining.
So it's
Declining
becoming less favorable as
to the buyer. To the buyer. More favorable to the seller, right? Because their properties are increasing in value. Less favorable to the buyer. It's becoming very, very difficult. It's been a very frustrating year in acquisitions for the whole asset class. So, I was at the ISS in Vegas, and they had an economic summit of big funds that are buying storage, and they're frustrated because they can't find the right project that yields what they want to get out of a deal. It's very, very difficult. Or when they do, it just gets scooped up faster than you can get your hands on. So that's kind of one of the value that a syndicator does is we're going in and we're kind of a fund that can take down a project and have the relationships in the market. We have 150 brokers that we call and contact on a regular basis. So we get first look at properties before they even hit the market. The last 3 deals we purchased never even hit the market because we have a relationship with a broker. We're a proven buyer. They know that we can put out an offering, raise the funds, take down the project, and do the right thing. And that reputation is what makes us, which affords us the ability to continue buying this, right? So I'm going to take you through. Yeah, go ahead.
With regard to self-storage, if I were to compare it like multifamily, right?
Sure.
The type of seller that would sell multifamily would probably be
Mom and pop.
property, probably they're running their own property management. They're having a hard time. They can't run it anymore. Property's probably running to the ground, and so that type of person would sell. In this particular case, we spoke about how easy it is to run the property. With that being the case, what type of seller would sell the storage?
Yeah, so this property, so 80% of self-storages are owned by mom and pop operators that only own one facility. So this industry is it's still unsophisticated in some regards. The reason why you always hear about multifamily and why it's so popular is self-storage barely holds a candle in the wind to the number of properties that there are. There are multifamily properties everywhere, right? I mean, there's self-storages everywhere, but there's a lot of more multifamily, right? The typical seller is just exactly as you described. Distressed, they don't want to own it anymore, they've run it into the ground. In this case, unfortunately, the gentleman has got terminal cancer and he had to sell the facility, got to get rid of it. So he wanted to turn it over before he died. We strongly recommended from the tax perspective that he hold it until he died, then in a trust, move it to his kids, but he just was insistent on just making it go away. He wanted to see it through to the end, no problem, right? So we work with him in that regard. So, and we're gonna go through this, and I'm gonna show you how you can see the value in, when you look at these properties, that there is opportunity. So, real quick, just a quick capital stack. If anybody doesn't know what a capital stack is, it's essentially, just imagine you need all this money to do this, to set out your business plan. You need to have operating reserves, you need construction, you need to buy the property, you need to put down a down payment, you're going to get a loan. So you're going to usually in a typical capital stack, you have debt and you have cash, right? Equity, right? So in this capital stack, we bought the property for $6 million. We needed $1 million to build out additional units. We had $250,000 in project fees that went to the sponsor over time and up front. And we had $250,000 put in our operating reserve, so in case we ever ran into problems, we had operating budget. Okay, it's really important to have that. Now, where did all this money come from? We raised $2.3 million from passive investors that wanted to invest $50,000 at a time in the deal, and we went to a local bank in Texas and secured the debt, $5.2 million. And so that was our capital stack. Everybody cool with that? Capital stack, debt gets paid back first, equity gets paid back last. Okay, so you owe the bank and then you owe your investors, right? So, I think we're losing battery power on this thing. Here we go. So,
Our investment group is excited to announce the most recent acquisition of a self-storage facility in Corsicana, Texas. This is a value-add purchase, and we're going to head over to the facility and check it out. Here we are at Mini West Self-Storage, and the facility boasts 735 units spread across 81,000
it was 98% occupied when we bought it. Physically occupied, we'll go over that in a
And the
second.
land actually is 9 acres.
9-acre
covers the
site.
entire project. 2 of which
2 for
is vacant,
expansion.
and we can
So we can
further
put about
expand the
250
self-storage
units,
business on, which is
additional
one
units on
attractive
that
part of the
expansion.
deal. The opportunity also comes with a car wash that
Happens
has
to come with a
5
car wash.
bays.
Okay.
One is an
Ancillary
automatic,
source of revenue, 5-bay car
self-serve,
wash,
and the
4
facility
automatic,
has
1
many
self-serve.
different revenue streams.
I'm sorry, 4 self-serve, 1 automatic,
rental
and it had U-Hauls.
business. It also has a UPS.
At retail, we're gonna add propane to it, we're gonna do a few other things. But that's essentially the opportunity, okay? So when we put this under contract, we're not aggressive with the buyer or with the seller. We're taking our time. We're gonna do a 4-week feasibility, right? And feasibility is, can the market support our additional units? So we're gonna do a market study for 4 weeks, okay? And once we completed our feasibility study, then we go to the broker and say, hey, we're ready to put this under contract because we did a market study and we feel like we can execute our business plan. Okay, we haven't talked to any investors yet. So we did a 60-day due diligence period where we go through property inspections, geotech, civil engineer, all the things that go into doing your due diligence. We have a 569 due diligence point or checklist, right, that we follow for every property. I'm happy to share it with everybody. Send me an email. I'll share the due diligence tracker. We run the same due diligence checklist for every single property, and we had $60K of earnest money. That earnest money wasn't hard. It was only hard when our due diligence period ended, and we could still get our due diligence money back if there was a fraud with the title, or we couldn't close, or the seller couldn't sell the property, or whatever it was. Okay, so we put under contract. So the property was 97% physically occupied, 83% economically occupied. What does that mean? How's there a spread? Imagine that you charge $1 to rent your storage facility, and you're 100% full, but on average, everybody's paying 96 cents. Okay? You're 100% full, but you're 96% economically occupied. Make sense? So there's a spread there, and that's where the opportunity exists. So we did a study, and we found out that we're 83% economically occupied, but we're physically 97.7. Somebody's not charging enough, right? And there's opportunity to increase that, right? So we mystery shopped all the competitors, 7 main competitors, and don't worry about reading all this. There was a gap between the rent that he was charging and what the tenants were paying. And there was an additional gap in the market. The market was saying, you can charge $150 for a 10 by 15 unit, and this guy was only charging $105.
You talk about you need a month on a feasibility study, but if you know you're already 97% occupied, what feasibility study do you need? It's 2 minutes.
So imagine you go down to the building department and you can't find it online, but you find out that 3 people have building permits in the pipeline. Yeah, you need a week to go down there, you need to bebop around, you need to knock on doors, you need to check things, you need to look at population growth, rent growth, all the things in the market. You need to do a full study to make sure that you can do what you're setting out to do. And that usually comes in the form of an LOI, letter of intent to the seller. It's non-binding, we intend to buy your property pending this feasibility. Do we have a gentleman's agreement that you're not going to let anybody buy it? Yes, we do. Okay, do your feasibility. And here are the proposed terms of a contract. Are you cool with everything? Yep, we're cool. All right, rock and roll, right? No reason to go under contract if you're not going to buy the deal, right? We have a 100% contract to close ratio. We've never been under contract and not closed. And that's because we do our feasibility up front so the seller knows that when we come in, as long as everything's been represented truthfully and accurately, we can close on the property. So this is where the numbers come important. So in self-storage, you got 5 by 10s, 10 by 10s, 10 by 15s, 10 by 20s, all that stuff. Okay? We looked at the rent roll. The rent roll is a snapshot of everybody that rents your facility and how much they're paying per unit. Okay? Notice that there's 67 units at our facility when we bought it, paying $47 a month. Okay? But I've got people paying $23 a month. Right, you're shaking your head. You run these things. So we went, okay, 23, 24, 26, 30, right? And we went through every single unit in the rent roll, and we figured out what the gap was between, what the opportunity was between what people were paying, what they could be paying, and then what the market's paying. And we figured out that there was a $110,000 a year gap in revenue. that we can increase rents by between actual and standard rent. Our standard rent's 47. Why is somebody paying $23.50? Okay, they've been on that summer move-in special way too long, right? Right, time to chime in. And I mean, these tenants were paying that for 6 months. Nobody was raising the rent. Nobody was cracking the whip, right? So we said, we also found that there was a $55,000 a year gap between $47 and the facility down the road is paying $55. So why are we only charging $47 when everybody in the market's paying $55? That's why you do your feasibility study. So holy cow, there's an opportunity here, right? So here's what we pitch to our investors. We don't say $165,000 a year, because what if we can't execute, right? So we underwrite, we say $72,000, and we give ourselves 18 months to do it, because you're not going to take over and raise the rents the first day you buy the property, right? So we said that $72,000 increases over 18 months is what's going to derive the return that I'm putting in front of you. Super conservative. We also, so that increased our cash flow by $6,000 a month, and it added 1.02 in value to the property. Now we're target dispositioning this at about a 6.5 cap. So if you take 72,000 divided by 0.065, that's how you get $1 million of value added to a property. See how cool this is? When you have 735 units and you just raise everybody's rent by $10 a month because you can, because you're cheaper than everybody in the market, you can create $1 million of value like that. And $6,000 more a month cash flow. Way more fun than anything else. So then the next thing we went to our civil engineer and we said, hey, take a look at this map and see what we can build, okay? And the civil engineer said, you can build 40,000 square feet of additional storage. Okay, you've got a gas easement coming through here. Can't put any buildings on this gas easement. You're gonna have to put a detention pond in for stormwater control. And so he maximized this out at 40,000 square feet. Our market study came in at 38. The market study said you can build 38,000. So we're gonna build 36,000 additional square feet on this property and be assured that the market will support it. But to our investors, we said, hey, we're gonna build 20,000, okay? We're gonna under-promise, right? If you're new to this syndication stuff especially, and you're under-promising and over-delivering, it's way more fun than shooting for the moon and telling everybody you're gonna, shoot for the moon and you land at the stars and or shoot for the stars, land the moon, whatever it is. But to do that, we had to get $1 million to build it, another 20,000 square feet of storage. We pro forma 6 months to build it out, and then we gave ourselves 15 months to lease it up, right? So we got a 21-month timeline to build it and lease it up. That's going to add $2.34 million of value to the property. Okay? So in total, here's the opportunity, right? We can raise the rents. We told our investors $72,000 a year of rental rate increases, $155,000 a year with the expansion, and there's their existing NOI of 44.3, right? So we're going to now have the NOI at $670,000 a year, which values the facility at 10.15. Pretty cool, because we're buying it for 6. Okay, so we're selling it for 10.15. We're cash flowing along the way. So you're probably wondering, maybe this is a little advanced, maybe it's too basic, but how do we adjust for our expenses? How do we underwrite this? So our assumptions are 40.3% expense to income EGI, right? Expense to gross income ratio. So we're saying that if we make $1, our expenses are 40 cents. Okay, and then we're making 60 cents after that. Our max economic occupancy, remember we talked about the max that our pro forma would ever get to is 90%. 20,000 square feet of expansion. Our exit cap rate was 6.6%. So 7.38% was a deal, right? But we're gonna market this at where storage is trading at. Storage is actually trading at between 5 and 6%. We want to be conservative on the exit, so we estimated a cap rate that was a little higher than what the market was trading at, which is good. 5-year hold period. Now, getting a loan on this, right? We wanted specific terms so that we could cash flow, right? We had to call 80 lenders to get what we wanted. 80 lenders, banks, to get the terms that we wanted. We ended up getting 75% leverage. We got 6% interest, which isn't great, but this is a tertiary market. 2%, 2 years of interest only. So IO payments, we don't have to pay principal for 2 years, allowing our investors to cash flow. We got 25-year amortizing loan after that, and we have $1 million to draw on a construction loan for 3 years whenever we want to build those additional units. Pretty cool. And that's not, we're not paying that up front, we're only paying 4.2. Okay, so here comes the cost segregation study. So, when we bought this facility, we did an estimate of cost segregation. So we paid $6 million for this facility. We had our estimator come out there, and they said that you guys are going to get $1.3 million right off of the first year. Bonus depreciation, right? So $1.3 million right off of the first year. This actually came out, when the study was produced by our engineer, it came out at 1.6. So if you invested in this project, you would be handed a loss, even though you're handed cash flow. Cash in pocket, loss on paper. So you get your K1 at the end of the year, or the beginning of the year, end of February, we send them out. And we've been distributing 8% cash flow to our investors every quarter, 8% per annum. And they're gonna have probably, each investor on 50K is probably gonna have somewhere between a $15,000 to $20,000 loss on paper, which then they can carry over into subsequent years and never pay any taxes while we hold the investment. Right? So we do that on all of our properties. Some say that self-storage depreciates a little bit better than multifamily because it's more of a temporary building, it's more metal walls, there's less permanent components per the IRS. I don't know if that's true, might be, but one thing's for sure. When we buy RV parks and mobile home parks, those are the most depreciable assets out there because there's no buildings. I don't want to get into I don't want to steal your guys' thunder on depreciation, but basically when you depreciate an asset, this is so important because it can change your real estate investing. We sold a condo building in DC. We paid $1 million. We made $1 million on a condo building in 2018. That same year, so we had $1 million of earned income, the worst, because we built the condo building and sold it. The worst profit you can earn is earned income because it goes right to the bottom of your. If you made $200,000 that year, now you made $2 million or $1 million plus $200,000, right? That's the worst income you could have. But when you buy cash flowing real estate, this is why we got out of residential and flips. When you buy cash flowing real estate, you can depreciate the purchase price in the year that you buy it, right? Because it's entered into service. So we bought an RV park in West Texas for $1.74 million, and we got a $1.35 million depreciable write-off year one. So that $1 million gain that we had was gone, right? I had a loss. So I made $1 million, bought another property in the same year, bonus depreciation wiped out all of my gain, I paid no taxes. So, and our partnership in the syndication shares in those benefits as well. So with an RV park, what the IRS does, they come in and they say, okay, what's your building worth? Okay, that goes into 39-year life, can't depreciate that. What's your land improvements, building contents, what is that worth? You can accelerate that, depreciate all in the first year, and land, whatever you value the land at, you can't depreciate at all, so you can't depreciate land, right? And with the new tax code, they allow you to take bonus depreciation, which allows you to take all of the short-term life and depreciate it in the first year. It's pretty cool. So it's pretty powerful stuff. So anyway, a little bit about what we do. We send out our investors quarterly updates on the financials, and we send all of our investors a monthly update on the project. Because as Carlton was mentioning, this isn't liquid, so it's really not fun when you don't know what's going on, right? So we send out an update on the 15th of every month, project by project, to our investors to let them know exactly what's going on, and we do financial reporting. So this is a real live financial report from Q1. So this was, we do a distribution analysis, NOI, revenue, and expense, and we show our investors where we should have been and where we actually are. So you can look at it and go, okay, we're doing better than we thought we were, or we're doing as expected, or whatever, right? This is how you join our list. This is our newsletter. We send out a quarterly newsletter to our investors, and then we send out deal flow. So that's kind of our newsletter, and I got time for questions, I think.